The stock market has always had a few surprises up its sleeve, something that any investor in 2020 would not deny. Welcome to our channel, Financial Insights, place where you are always a little bit smarter and wiser after seeing one of our valuable videos so you can develop your financial knowledge. Don't forget to press the like button and subscribe to our channel so we can make even more financial content. Without any further ado, let's jump right into the video now, shall we? Even in 2021, the biggest factor experts are considering while identifying the best stocks to buy in 2021 is just the same as it was last year, and that is COVID-19. The top stocks of 2020 were directly or indirectly tied to those companies that benefited from the new and accelerated trends resulting from the pandemic-related lockdowns. Many of the best stocks that we will be discussing today for 2021 will be based on the benefits that the stocks received due to a return to normalcy and a healing economy. Choosing the best stocks for you to buy today largely depends on your current financial situation. That said, it is also essential to have a diversified portfolio. So let us start with our picks, shall we? Number 1. Fiverr International. With the recent layoffs and new remote working culture worldwide, so many people had to find new ways to make income online. This is where Fiverr displays its significance. The online platform helps to connect freelancers and potential clients, and it has indeed changed the way we work together. Using Fiverr, freelancers can seamlessly connect with parties that are looking to hire people for a wide range of services that include design, programming, marketing, animation, data entry, and so on. Fiverr's stock was up 740% during 2020, and it is still a relatively small company with a market cap of just under $7 billion. Fiverr is undeniably expensive when you look at the current results, but this stock is all about its future potential, and investors are willing to pay the premium based on the expectation for double-digit revenue growth to continue for some more time. With so many small businesses starting up, there could be a lot of growth for Fiverr as it helps companies connect with freelancers looking to monetize their talents. Investors should expect Fiverr stock to be volatile, but with momentum and exploding profitability, Fiverr is a risky growth stock that is worth the stretch for more aggressive investors. As we know that COVID-19 is restructuring the global economy, the remote working situation is turning into self-employment and freelance gigs for many people right now. Right now, this trend has serious momentum, and Fiverr definitely looks like the best way to bet on it. Number 2. PayPal. For those of you who don't know about PayPal, it is the largest digital platform that provides money transfer services. The whole pandemic situation forced us to rely on digital payments more than ever before. It is very evident from the evolution of digital payment systems around the world. PayPal's EPS rating is the highest possible, 99. The EPS rating measures a company's ability to grow profits year over year, using the most recent 2 quarters and the past 3 to 5 years of earnings growth. The SMR rating highlights a company's sales, profit margins, and return on equity. Such metrics offer significant insight into a company's fundamental strength. Driven by PayPal's double-digit sales growth in recent quarters, 26% annual pre-tax margin, and 23% annual ROE in 2019, the SMR rating is an A. According to the IBD Stock Checkup, PayPal stock boasts a 98 out of a perfect 99 IBD composite rating. The composite rating helps investors easily measure a stock's fundamental and technical metrics. In the latest quarter reported on November 2, 2020, PayPal earnings rose 41% to an adjusted $7 per share. PayPal revenue climbed 25% to $5.46 billion, including the acquisition of Honey. In addition to e-commerce growth, the Venmo person-to-person payment service also contributed to higher than expected TPV for PayPal. PayPal recently rolled out a Venmo credit card. The PayPal earnings report said it added 15.2 million net new active accounts. It had 361 million active accounts as of September 30th. In late November, PayPal launched the cryptocurrency trading service, allowing clients to buy and sell Bitcoin. PayPal customers will be able to use cryptocurrencies to shop at 28 million merchants on its network starting in early 2021. Number 3. Walt Disney. Even if you're not a fan of theme parks, there is a good chance that some of your money flows into Walt Disney Company's pockets because they own ESPN, ABC, and Marvel Studios, and many others. With a company like Disney, you also want to be familiar with where revenue is coming from or which divisions drive the biggest profits. This is the difference between knowing a company as a customer and knowing it as an investor. And there's no need to worry about the long-term money-making potential of the House of Mouse. To consider Disney's valuation, think of Disney Plus for a moment. Netflix is the largest standalone streaming service in the world. It's worth about $225 billion and has built up about 200 million subscribers worldwide since its launch. Disney Plus, on the other hand, has only existed since November 2019, and it already has nearly 75 million subscribers globally. Disney, which is worth about $279 billion, also has its studio entertainment, media networks, and parks, experiences, and product segments to boot. Analysts expect Disney's parks and cruises to hit operating income, but the streaming service would be a game changer. In short, Disney stock is a high-quality blue-chip stock at a good value. Number 4. Roku. After a stellar 2020 performance, shares of Roku got off to a strong start in 2021. The streaming video company's stock price is up by about 25% year-to-date, and Wall Street analysts think it still has room to climb. The gains thus far in January have been fueled by a combination of positive preliminary results released early in the month and a slew of analysis upgrades delivered over the last few weeks. More people are planning to cut the cord, and most paid TV operators aren't trying to keep them on as video subscribers. Roku stands to gain additional accounts and win more streaming hours per account as a result. Roku's acquisition of DataZoo, which was rebranded to OneView, gives it a strong position in programmatic ad buying. Combined with the growing ad inventory from its increasingly popular Roku channel, the company should see strong growth in ad purchasing on its platform. JP Morgan analyst Corey Carpenter expects Roku's ad revenue to climb by an average of 48% per year from 2020 through 2023, reaching $3.7 billion in 2024. Last quarter, Roku's user base grew 43% to 46 million, while streaming hours grew 54% year over year to 14.8 billion. Advertising on the Roku platform makes up the bulk of the company revenues, as platform revenue, which includes advertising, jumped 78% last quarter. The recent addition of HBO Max to Roku's platform illustrates how the company's rapid growth makes it more desirable to streaming apps, making Roku more useful to consumers, powering a feedback loop that drives its business. Despite the run-up in price that is already in the rearview mirror, Wall Street still has many reasons to love Roku stock. Number 5. Shopify. Shopify is an e-commerce platform that provides small businesses to set up their shop online and build their brands. The Canadian company helps more than 1 million merchants across 175 countries to sell and market their products. In return, it earns subscription fees. It also offers shipping, digital payments, and fulfillment. In 2019, subscriptions accounted for 41% of revenue and merchant solutions for 59%. Shopify stock earns a superior IBD composite rating of 95 out of 99. The rating combines key fundamental and technical metrics in a single score. The e-commerce software company has a 77 RS rating. That means it outperformed 77% of all stocks over the past year. Shopify earnings are to soar 1,147% in all of 2020 and to fall 5% in 2021. And revenue is likely to jump 81% in 2020 and to increase 31% in 2021. Take analysis estimates with a pinch of salt in the pandemic market. Number 6. Alibaba. Alibaba stock sold off sharply on December 24th on news the Chinese government launched an anti-monopoly probe into the e-commerce giant. But shares rallied sharply on December 29th on news progress is being made to overhaul Ant Group's operations into a financial holding company. Ant Group is the fintech arm of Alibaba. Ant Group operates a suite of financial products, including the widely used Alipay digital wallet in China. When it comes to liquid mega-cap stocks in China, it's hard to find a more compelling name in terms of fundamentals than Alibaba. Alibaba's cloud computing business shows solid growth, just like Amazon's booming web services business. Alibaba's digital media and entertainment unit are also rising. The unit includes Alibaba's video streaming platform, Youku, along with its music streaming service, Xiaomi. Alibaba also has a licensing agreement with Walt Disney unit Buena Vista International, giving it access to many Disney content. In 2021, it's better not to get swayed by past returns. Overinvesting in one asset and underinvesting in another based on past returns will prove disastrous, so it is wise to rebalance your asset allocation from time to time. Ignore the market noise. Also, who knows if a second wave of COVID-19 is waiting for us, forcing countries to adopt more lockdowns, causing the market to panic. With that, we have come to the end of our video. Let us know in the comments if you've already invested in Alibaba. Thank you for watching, and make sure to subscribe and check out our other valuable videos. See you soon at Financial Insights.